Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, so with this, let's take a look at something on this site. Let's go to the option chains. And let's say that I want to see what some option prices are on EUU. Now, EUU is the euro. So with that, if you think that the euro is going to go up, you buy calls. If you think the euro is going to go down, you buy puts. Now, obviously, you have implied volatility risk, time decay, and all that fun stuff. But bottom line is, this is one thing to where it goes up. This underlying will go up in value as well. So in taking a look at this, one thing that we can do, we can actually, not one thing, several things of which we can do on this. We can actually do an income-based trade on the euro itself to where we're not going to have any bond exposure, so to speak. We'll still continue to get income, and we'll have exposure to the euro. And I want to show you how you can do this. Now, let's start off. I know I said earlier that we're going to assume trades are done in an IRA account. Or a non-taxable account. For this first example, I'm going to make an exception to that rule. We're going to do this in a non-IRA account just for sake of simplicity, so to speak. But we're also going to assume that there's no taxes on it also, just to kind of keep things as simple as possible. So with this, like I had said earlier, we have about $150,000 with which we want to have exposure to the euro. So with that, one thing that I could do, if I was able to buy this underlying, I could buy 1,100 contracts on this, and I would pretty much have $150,000 worth of exposure to the euro. So what I'm going to do in this example, we're going to do an 11 lot. It worked out when I made the slide yesterday, it worked out as a 10 lot, but we went down a lot, so we're going to have to use an 11 lot today. Because of the fact that the euro went down so much today. So when I was setting this up for the numbers yesterday. So with that in mind, let's start out with a cash secured put. What we're going to do, we're going to sell the 131.5 put. Now right now, the euro is at 133.68. And with the cash secured put, the way with which we're going to set it up, and actually, you know what, to keep this simple, we're going to just do a 10 lot, but we're going to have just $130,000 for this. So once again, my apologies. When I did the slides yesterday, we had the euro was higher, but for right now, we're just going to assume that we have about $130,000 of exposure that we want to have on this. So on this, let's say that we were to sell this 131.5 put, we would get approximately $100 per contract, or in this case, we would get about $110 per contract. Now let's go ahead and put this on the trade calculator. So that way we can kind of get a visual of this. So in looking at this, it's a very similar trade to that of the covered call, to that of just selling a put on a stock. And ultimately, your risk on this trade, let's assume the euro goes to zero. Now, I don't think the euro is going to go to zero tomorrow, but let's just say, for sake of example, that it did. What your loss would be on this trade would be 133.67 times 1,000, because you're selling 10 puts on this. And let me rephrase that, 131.50 times 1,000, because that's where your obligation lies, minus the premium with which you're collecting. So on this, you can see that the requirement on this trade would be that amount, and we're going to assume that this is cash secured. If it's in a margin account, then it would be less than that, but we're going to assume that this is cash secured for right now. And your actual risk is $131,000, and your potential monthly income is a little dollars. So when doing that, when doing the math on that, it's out to about 0.7% over the course of just under a month. Now, with that being said, a lot of times in a bond, if you look at interest rates these days of corporate bonds, I don't know what time frame you're looking at, but if the 30-year government treasury is paying around the 4% level, the U.S. government treasury. So let's say that you do a long-term corporate bond, you're probably going to get maybe 6 to 8%, just depending on what grade that you're going for. And if you're looking to do something overseas, this is a way with which you can have the same exposure to the euro and get an income on it. So once again, I'm not trying to say that all bonds are evil or anything like that. I just want to point out to you that this is just another alternative with which you can do on the euro and still have a little bit of income. Now, which strike price would work best for you? Once again, that would depend on your individual situation. Perhaps it would work better if you went up to the 133 level to sell your cash secured put. Or maybe you think this is a little bit too close for comfort. Maybe go down to the 129 or the 128 level. It all depends on your own situation. But once again, if you want to have exposure to the euro and collect an income, like a lot of people do in overseas bond funds, this is another way of doing it as an alternative. Now let's take this a step further. Let's say you're looking at this and you're like, good gosh, Mike, I like the idea of having the currency exposure, but I don't know, on second thought, this is kind of concerning to me because after all, look at what the euro did today. It's down quite a bit today. I think I'd like to have some type of a risk management in place in terms of a hedge. Well, that's an area with which you can set up something that's known as a credit spread. So let's say, for example, that we sold the 131.5 put. One thing that we could do as a way of hedging it, let's just take the 129.5 put, and we'll create a credit spread on this. So with that being said, now we're not going to get that $1,000 worth of income at this stage because of the fact that we had to buy protection on this. So the actual income that we're getting on the trade, it's not $1,000 anymore. We're going to have to use some of that $1,000 to pay for the protective leg of this spread. So now we're only getting $390 on this specific trade. Okay, not quite as good as it was before, but here's the advantage of it. You're only risking $2,000. It is mathematically impossible to lose more than the distance between strike prices minus the credit. And in reality, the most you're going to lose is $1,610, not including commissions. That's the most it's mathematically possible for you to lose on a credit spread. So let's say that you like that idea. You like the idea of income coming from the currencies, not having the bond exposure. But good gosh, you just don't want to have a day like today going down your going to sleep at night, so to speak. So one thing that you could consider doing, taking perhaps 125 of that $130,000, putting it into a money market. And let's say you're concerned with that money market's currency risk, put on a credit spread, and it doesn't necessarily have to be these contracts and these amounts, but the credit spread can act as a way of hedging you against an increasing euro. So that's another way with which you could consider it if you're concerned with a rising euro and you want to have something income-based.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.